Welcome to Taking Stock for the week ending the 24th of June, 2022. I'm Trinh, and joining me today is our Senior Equities Analyst, Jason Yin, to stream to you all things share market. Great to have you on board again, Jace.
Thanks again, Kien.
Before we get started, just a reminder that the information provided today is generic and shouldn't be considered personal advice. Remember, shares are volatile, and any charts and tables shown today should not be relied upon as a guide for future performance. So following a 10% decline over the last 2 weeks, the Australian and US share market appears to have found some footing, but the market support appears more a function of a relief rally rather than any real positive news. In fact, the underlying issues about inflation and interest rates remain intact. The market is now expecting the cash rate to move to around 3.5% by the end of the year to combat inflationary pressures, Jace.
This is a really interesting point, Kien. It's actually a stark contrast to the predictions made by the RBA last year that interest rates were not actually going to rise until at least 2023. Now the market is pricing in the possibility of a US recession in 2023 as central banks tighten rates to try to bring inflation towards their 2% target.
Yes, Jace, but it's important that we don't focus on the forecasts or predictions. Remember, the reality is we don't know what will happen in a year's time. And even Ray Dalio, the co-founder of Bridgewater Associates, he said that hearing the supposed experts is like listening to nails scratch against a chalkboard because they typically say incorrect things in an erudite or intellectual way. We need to focus on the facts right now. And our economy remains strong with corporate earnings resilient and the unemployment rate at historical lows. Remember, rich in natural resources, Australia is a major exporter of commodities, and our economy benefits from elevated commodity prices during inflationary periods. We understand that rising interest rates and quantitative tightening can lead to slower economic growth. But a reset is healthy for the market. It removes all that speculation and the zombie companies that should have collapsed long ago. As Warren Buffett once stated, only when the tide goes out do you discover who's swimming naked.
Yeah, that's always a great quote. But it's also important to remember to reevaluate your portfolio during this period. Have risk management strategies in place to ride through the cycle. Be diversified according to your stage of life, and also concentrate on financially healthy companies with high profit margins and strong cash flows. The other ones to look for is looking for companies that have sustainable dividend rates, and this will ensure that you can continue to receive a steady income stream. Remember to also take advantage of any oversold quality opportunities that will eventually rebound once inflation gets under control.
Yes, Jace, risk management is so important, especially across the volatile resources sector as well. This week, we had BHP, Rio Tinto, and even Grange Resources. They were sold down, and that follows on from a fall in the iron ore price on concerns about Chinese economic outlook. Investors are worried that the demand linked to China's plan to boost infrastructure investment may not materialize, especially with China's COVID zero policy still intact. And although restrictions have now eased, there's new outbreaks in Chinese cities like Macau and Shenzhen over the week, and that highlights this uncertainty. Meanwhile, stockpiles of steel construction production remain quite elevated.
But despite the volatility, we haven't seen any evidence of a deterioration in earnings for BHP or Rio Tinto. As such, the dividends for these companies should continue to be supported by their strong free cash flows. Meanwhile, investors should be mindful that there are no forecast figures for Grange Resources, so you'll need to conduct your own analysis and monitor the iron ore price to understand the earnings trajectory for this company.
Yes, and both BHP and Rio, they are on gross dividend yields of about 15%, so quite attractive there. But we also saw a pullback in oil prices as well, mainly on US recession concerns and the US Biden administration stepping up its campaign to fight high petrol prices as well. But despite this volatility across Woodside Petroleum and Beach Petroleum, our star stocks, they could potentially provide investors with opportunity. especially with the oil market expected to remain tight on the back of the Ukraine-Russian conflict and also rising fuel demand in China.
And also interestingly, moving from oil onto gold, star growth stock Alkane Resources was sold off quite heavily during the week after the company's chairman and significant shareholder, Ian Gandel, sold 13% of his holdings via block trade at 75 cents. The purpose of the sell down was to finance Mr. Gandel's takeover of Alliance Resources by Gandel Metals. We do not view the sale as an active risk given Mr. Gandel still retains a sizable 22% of total shares on issue.
Yes, quite interesting there, Jace, but a key active risk that we continue to monitor and that's plaguing a lot of our companies is supply chain restrictions. And automotive parts supplier and borderline star growth stock and star income stock, GUD Holdings, they've been affected by China lockdowns and the Ukraine-Russian conflict, which has limited the number of new vehicles into Australia.
But we've retained these companies in coverage because we feel the share price sell-off has been overdone. Also, trend-sensitive investors should remain out of the stock, given that it has triggered an exit on both the SD30 TSR and SD Max.
And for income investors, there appears to be sufficient free cash flow margins above those dividend payments to help support the gross dividend yield of around 7%. And the stock is expected to go ex-dividend in less than 2 months.
Also as well, Kien, GUD might be at risk of being removed from coverage as a borderline star growth stock, and this is due to the potential decline in ROE in FY22. The forecast decline in ROE is a manifestation of the sizable capital raise that related to the Auto Pacific Group acquisition late last year.
Yeah, so those who are holding that stock should really reevaluate their positions. But similarly, salary packaging and novated leasing provider Smartgroup, they are facing challenging conditions because their novated leasing business is also affected by the limited supply of new vehicles together with higher interest rate costs. In addition, Smartgroup also reported a contract loss as well. So what happened here, Jace?
Well, the Department of Education and Training did not renew their contract, and this triggered a 5% revenue loss in FY23. The update was also particularly disappointing because Smartgroup has actually held this contract for the last 19 years, and it was an exclusive contract as well.
Yeah, but after a discussion with management and assessing the risk to the outlook, we have decided to retain the stock in coverage. And the reasons were management did suggest that there are no material contracts that are expected to be renewed over the next 2 years. Also, the limitation in new vehicle supply is only a transitory factor, which should unwind once supply chains restart. And furthermore, there is potential for further private equity interest following a failed takeover bid late last year. And of course, the share price appears oversold as well.
So for those that are actually quite trend sensitive, they should remain out of the stock because the stock has triggered a bearish signal on both the SD Max and also the SD30 TSR. Now onto the corporate calendar for the week ahead. We have Collins Food reporting its annual results on Tuesday, the 28th of June. Furthermore, CSR will be holding their AGM on Thursday, the 30th of June. Meanwhile, our REITs and utilities companies such as Arena, BWP Trust and APA Group, they're due to go ex-dividend on Wednesday, the 29th of June. And across our technical alerts, for those of you that are highly trend sensitive, Bendigo Bank, BWP Trust, Commonwealth Bank, Gemworth Mortgage Insurance, they all turned bearish on the SD Max. On a positive note, however, BHP turned bullish. Meanwhile, for the moderately trend sensitive investors, Alkane Resources, GUD, MMS, Objective Corp, Oz Minerals, Perpetual and Smartgroup, they all triggered an exit on the SD30 TSR.
On the topic of the global supply constraints of new vehicles, we cast our lens to automotive parts manufacturer ARB Corp. Remember, the company designs, manufactures, and also sells motor vehicle accessories to those four-wheel drives and SUVs segment of the market. But I noticed that ARB, they provided a trading update in early May, reiterating a shortage of new vehicles and increased inventory levels to buffer against the extended lead times. And this was the reason for the weak earnings quality and also led to the negative earnings revisions of around 4% over the last 3 months. But Jace, why did we retain coverage of the company at its first half 22 result?
Yeah, that's a really good question, Kien. The company was gaining market share in the four-wheel drive accessories market, and with the return on equity stable at around 27% and with net profit margins improving to 18%, we thought the factors were actually quite positive. The only weak part of the result was the decline in earnings quality, but this was due to management's decision to build up inventory to manage the strong demand in four-wheel drives and SUVs, and also to cushion some of the supply chain impacts that a lot of companies were reporting around that time.
Right. And I guess we had anticipated that supply chain disruptions would ease as COVID takes a back seat. But this wasn't the case in China, which kept one of its largest cities, Shanghai, locked down for about 4 months. Meanwhile, we had anticipated for the Russian-Ukraine conflict to resolve quite quickly. Unfortunately, Ukraine, they manufacture around 50% of the world's neon gas, which is a key element used in the production of semiconductors used in vehicles.
So with interest rates potentially rising, and this could dent the demand for motor vehicles, investors should note that there is a chance the company may downgrade their earnings or miss earnings expectations when it next reports in August. But despite this, we have retained the stock as a borderline star stock in our universe. And this is because we believe the share price decline since the start of the year and also the deep discount to valuation has somewhat factored in some of these risks, which we still believe are not structural. However, we need to see evidence of the supply chain pressures easing and a recovery in new car supply before we have more confidence in the share price turnaround.
Of course, and make sure you have strong risk management strategies in place here. But meanwhile, trend-sensitive investors, they should wait on the sidelines until a more bullish trend emerges on both the SD Max and SD30 TSR. But it's reassuring to see that the company's founders, Andrew and Roger Brown, they retain plenty of skin in the game at 6% of total shares on issue. And although it looks like they've sold some stock over the last 12 months, they haven't sold any stock since the start of this calendar year. Now, with the end of financial year approaching, our clients are preparing their paperwork for tax time. So a useful question this week is how can Stock Doctor help investors with their tax reporting? And the portfolio director in Stock Doctor can help clients monitor the stocks in their portfolio, providing performance metrics and also reports as well.
But as always, Kien, no matter how good a tool is, there is always a level of input that's required for the end user. So the first step to use this tool properly is to ensure that your holdings accurately reflect your broking accounts. This can be accomplished under the Securities tab. Down below, you'll see that your dividend payments, which are automatically generated by Stock Doctor, but it also pays, and excuse the pun, to double check the amount and to make sure that this is correct.
Yes, and you can also view your income and capital gains or losses by clicking on the Report tab. The income section links each amount to a tax return label reference to make the process of filling tax returns a lot easier. And the capital gains section will review any gains or losses you've made during the financial year, including the option to bring forward any capital losses from previous years. Under the reports, you can also see your historical transactions and portfolio returns as well.
So to generate reports for your accountant, simply click on Save to PDF or CSV, but make sure you select the right date range. And this is really important. For other asset classes such as cash, bonds, or property, you can refer to cash and term deposits or other assets. This will ensure the calculations of your entire portfolio is accurate. And if you have any questions on using the portfolio manager, feel free to contact one of our client relationship managers.
That's all we have time for today. Thanks again, Jace, for your contributions.
Pleasure, Kien. Thanks a lot.
Also, a reminder for those concerned with the market volatility to attend our Lincoln Live webinar on Monday, where our Chief Investment Officer, Tim Lincoln, our Portfolio Manager, Matt Swartz, and our Stock Doctor expert, Rob Manfrey, and myself help you answer all your questions. To summarize, we've got to invest based on facts, not forecasts or predictions. And with slowing economic growth and rising interest rates, the best way to prepare your portfolio for the year ahead is to look at those financially healthy businesses. Take care and have a happy, healthy, and prosperous week, everyone.